Welcome, ladies and gentlemen. My name is Peter Josef. Together we'll be going through a discussion about the week ahead in the FX markets. Before we start though, I'll leave you a couple of seconds to go through our risk warning and our disclaimer. Remember that our products are traded in margin and carry a high level of risk, and it's possible to lose all your capital. Also, remember that the information provided in this webinar is not to be considered as an investment advice or investment recommendation. Instead, it's only educational material. Now, the market sentiment seems to be improving slowly as worries for the adverse effect of COVID's Omicron variant seem to ease. Overall, we may see this switching between optimism and pessimism about the new variant to continue to affect the markets fundamentally in the coming days, leading to safe havens and riskier currencies in different directions. On the other hand, as market worries about the pandemic's Omicron variant ease, attention is shifted towards central banks and accelerating inflation. The coming week is expected to be packed with high-impact financial releases and monetary policy events. On the monetary front, we highlight the Fed's interest rate decision, that's on Wednesday. On Thursday, we note the release of ECB's and BOE's interest rate decisions, which could also create substantial volatility for the markets, while the same day we also get Norway's Norges Bank's, Turkey's CBT and Switzerland's SNB interest rate decisions. On Friday, we get from the land of the rising sun BOJ's interest rate decision. As for financial releases, we note on Monday Japan's Tankan indicators for Q4, and on Tuesday UK's employment data. On Wednesday, we note the release of UK's and Canada's CPI rates for November, as well as New Zealand's GDP rates for Q3. Now, in a packed Thursday, we make a start with Australia's employment data for November, followed by France's, Germany's, Eurozone's, UK's and the US preliminary market PMI figures for December, while in the American session from the US we also get the weekly initial jobless claims figure, the Philly Fed Business Index for December and the industrial production rate for November. On a more easygoing Friday, take note of the release of Germany's IFO indicators for December. Moving now to the US dollar, and this would be the USD index. Now the US dollar has stabilized and it has been moving in a channel between the 96.65 resistance line and the 95.60 support level. However, it seems that the market action has been tightening around the 96.15 currently support line and has been revolving around it. We tend to maintain a bias for a sideways motion as long as the R1 and the S2 remain intact. Now to the upside, besides the R1, we would also note the 97.30 R2 and the 97.80 R3. To the downside, besides the 95.60, we would also like to note the 94.95, which provided considerable support around the 12th of November. Moving now to USD's fundamentals. The USD seems about to remain rather stable for a second week in a row, yet please note that November's US CPI rates are still to be released later today and could increase volatility. Overall, the easing of the market worries for the Omicron variant did not seem to affect the USD considerably. On the monetary front, the market's eyes are fixed on the Fed's meeting on the 14th, 15th of December. Fed Chairman Powell had clearly stated last week that the Fed is to discuss the possibility of an expedition of the tapering of its QE program. Thus, market expectations for such a scenario were enhanced. On the other hand, November's US employment data seemed to send mixed signals, as the NFP figure was disappointing, yet the unemployment rate retreated. Then there is also the uncertainty of the Omicron variant that the Fed will also have to weigh, given that Fed Chairman Powell had mentioned it in his testimony before the Senate. On the flip side, inflation rates seem to remain at high levels, adding pressure on the Fed to act. Should the Fed actually decide to accelerate the tapering of the Fed's QE program and the market starting to feel the hawkish shift of the bank, we may see the USD getting some support as the suspicions for earlier rate hikes could be supported. Should the bank disappoint the markets, we could see the greenback tumbling. As for financial releases, we note on Tuesday the 14th the PPI rates for November. On Wednesday the 15th we get the New York Fed Manufacturing Index for December. On Thursday we get the number of US building permits and housing starts both for November, the weekly initial jobless claims figure, December's Philly Fed Business Index, and November's industrial production growth rate. Moving now to the pound, and this would be cables for our chart with a crystal clear downward trend line, which was even tested early this morning. We tend to maintain a bearish outlook as long as the pair remains below the downward trend line noted in our chart. To the downside, we note the 1.3160, which in the past days provided some support, while to the even lower we note the 1.2990, and the lowest level noted would be the 1.2855. To the upside, we note the 1.3280. Higher than that would be the 1.3430, and the highest level noted in the chart would be the 1.36, which practically capped the pair's upward motion around the 9th of November. Moving now to the pound's fundamentals, the pound seems to have limited its losses against the USD, yet bearish tendencies seem to remain present. It's characteristic that the pound seems also to be losing ground against the euro, but not JPY. On the monetary front, the question on whether the BOE is to hike rates or not is to be answered on Thursday, the 16th of December. Currently, GBP/OIS implies a probability of 76.22% for the bank to remain on hold at 0.10. Yet we have to note that before the last meeting of BOE, it implied that there was an increased possibility for the bank to hike rates, yet BOE remained on hold. Inflationary pressures are building up in the UK, and at the same time we must note that Powell's hawkish turn seems also to provide cover for BOE to hike rates. On the other hand, the uncertainty of the Omicron variant and the stricter measures announced by the UK government seem to advise caution for the bank. Now, should the bank actually proceed with a rate hike, we may see the pound getting some substantial support, while should the bank remain on hold as expected, we may see the pound retreating. Other factors that should also be considered are to be the tone of the accompanying statement, and especially in case the bank remains on hold, as well as the vote count of how many BOE policymakers would be in favor of a rate hike. As for the bank's QE program, we expect it to remain unchanged at a total of £895 billion. On the pound's fundamentals, the new, stricter measures undertaken by the UK government to curb the spreading of the pandemic seem to weigh, while there are expectations for infections to reach 1 million by the end of December. It should be noted that the announcement of the new measures seems to draw criticism, also from UK PM Johnson's own Conservative Party. Also, we must note that the mini-crisis which has erupted in the UK government, with the possibility of the UK government lying to the public, is still an issue, despite the resignation of a Downing Street 10 aide. As for financial releases, we note the release of UK's employment data on Tuesday, the 14th. On Wednesday, the 15th, we get UK CPI and PPI rates for November, and Thursday, the 16th, we get December's preliminary PMI figures. Moving now to JPY, and this would be USD JPY's 4-hour chart, also moving in a sideways motion despite testing the 113.70 resistance line. We tend to maintain a bias for a sideways motion between the 113.70 and the 112.75. Nevertheless, to the upside, we also note the 114.45, which provided some resistance around the 18th to 19th of November. Higher than that, and the highest level in the chart would be the 115.45, which successfully managed to reverse the upward motion of the pair around the 23rd to 24th of November. To the downside, besides the lower boundary of the sideways motion, which is the S112.75, we also note the 112.10, and lower than that, even the 111.30. Now, JPY seems to be relenting the gains made against the USD in the past week, yet seems to be losing ground also against the euro and even the rather weak GBP. Now, the Japanese currency seems to be experiencing safe haven outflows as the market's worries about the Omicron variant seem to ease. Reports about the new variant of the pandemic having mild symptoms seem to multiply, yet scientists tend to warn that it may be premature to draw safe conclusions. Despite some degree of uncertainty still present, as long as the market worries ease, JPY may continue to experience lower demand as a safe haven. On the monetary front, BOJ is to release its interest rate decision on Friday and is widely expected to remain on hold at minus 0.10%, and currently JPY OIS implied probability of 97.49% for such a scenario to materialize. Now, given the uncertainty posed by the pandemic for the recovery of the Japanese economy, especially given the suffering of the manufacturing sector by the shortage of semiconductor supply, we expect the bank to maintain its ultra-loose monetary policy. The statements made by BOJ Deputy Governor Mamiya on Wednesday that there is no need for the bank to alter its ultra-loose monetary policy as long as inflation remains below the 2% target was characteristic. As for financial releases, JPY traders are to have an early start, as during Monday's Asian session, we get the machinery orders growth rate for October and the Tankan indexes for Q4. On Thursday, the 16th of the month, we get Japan's trade data for November and the preliminary Jibun Bank manufacturing PMI figure for December. Moving now to the euro, and this would be Euro USDs for our chart. Also moving in a sideways motion for the past 2 weeks, which were contained by the R2 1.1370 and the S1 1.1225. Practically, the price action seems to be revolving around the 1.13 level. To the upside, besides R1, R2, we also note the R3 1.1435, which served as a support line, yet as the price moved lower, has now turned into a resistance line. To the downside, we note the 1.1225, the 1.1165, and the round number of 1.11. Now, the common currency seems to edge lower against the USD for the week, yet remains in the greens against GBP and JPY. The pandemic is still a key fundamental issue for the trading bloc, given that Germany's and France's number of daily cases is still at very high levels. On the monetary front, we highlight the release of ECB's interest rate decision. The bank is expected widely to remain on hold, yet there is a wide discussion on whether the bank should start tightening its monetary policy or not. Inflation is accelerating in the area to levels not seen for years and seem to be adding pressure on the bank to act. Now, ECB's President Lagarde had defended the bank's narrative of the temporary nature of inflation and pushed back against the idea of hiking rates in the coming year. That was made a number of times, and by characterizing such a scenario as very unlikely. On the other hand, Germany's Bundesbank President Weidmann and ECB board member Schnabel tended to highlight the negative effects of inflation and express their concerns on the issue in the past weeks. Now, the bank expects inflation to peak in December and retreat, yet inflation may have already passed ECB's expectations. Given the uncertainty of the pandemic that has still a firm grip over the euro area, we may see the bank taking a wait-and-see position with some degree of cautiousness. On the other hand, though, ECB may repeat that it will not hesitate to act should the circumstances call for it. Now, as for financial releases, next week we note the release of October's industrial production growth rate for the Eurozone on Tuesday the 14th, as well as November's final HICP rates for France and Eurozone on Wednesday and Friday respectively. The highlight of financial releases for Euro traders, though, is expected to be the release of France's, Germany's, and the Eurozone's preliminary HICP rates for December in the chart you're already watching, and that's to be made on Thursday the 16th, which is closely watched by Euro traders and could create volatility for Euro pairs. Moving now to the Aussie, and this would be AUD USDs for our chart. Now the characteristic of this chart is that practically the downward motion of the Aussie against the USD has been broken, and actually the pair has tested the 0.7170. For the time being we maintain a bias for a sideways motion between the 0.7170 and the 0.71. Nevertheless, should bulls actually take the reins over the pair's direction, we may see it breaking above the 0.7170, start aiming for the 0.7230, which actually provided some resistance back on the 23rd of November. Higher than that, we also note the 0.7290, which was also capping the pair's bullish pressures around the 17th to the 19th of November. To the downside, we note the 0.71, which provided considerable support around the 30th of November, while even lower, we note the 0.7045, also which was used as a jumping start for the pair around the 6th of December. The lowest level noted and the lowest level in our chart, which successfully reversed the downward motion of the pair on the 3rd of December, is the 0.6990. Now, the Aussie seems to have halted its weakening against the USD for the past 5 weeks, as it seems about to end the current week in the greens. The easing of market worries about the Omicron variant of the pandemic seems to have provided also support for the commodity currency. Now, it should be noted that the latest data released in the past few days were not so unfavorable for the Aussie as well. Australia's trade surplus seems to have narrowed for October, yet China's import growth rate for November accelerated substantially, which could be also considered as a sign for better days ahead for Australian exporters of raw materials. On the monetary front, RBA's interest rate decision seemed to leave Aussie traders unimpressed. As was widely expected, the bank remained on hold. And at RBA Governor Lowe's accompanying statement, despite noting the uncertainty in the markets by the Omicron variant, seemed to be more upbeat. As expected, he noted that household consumption is rebounding strongly and the outlook for business investment has improved. As for financial releases, we note from China the industrial output growth rate for November on Wednesday, while from Australia on Thursday the 16th we highlight the release of November's employment data. Now, should the data show that the Australian employment market is tightening, we may see AUD getting some support, as it could provide a boost to RBA's confidence. At the same day, we also note the release of the preliminary PMI figures for the month of December. Moving now to the Canadian dollar, and this would be USD CADs for our chart. Now, the pair has broken the upward motion, which has been characterizing it since the 27th of October, and has more or less started to rebalance around the 1.2710 resistance line for now. It's actually teasing it. We tend to maintain a sideways motion for now, given also that the RSI indicator below the 4-hour chart is at the reading of 50. To the upside, we note the 1.2710, which is actually providing resistance right now. Higher than that would be the 1.2775, and the highest level noted would be the 1.2855, which capped the pair's upward motion around the 4th of December. To the downside, besides the 1.2645, we also note the 1.2585, and the lowest level noted would be the 1.24, which successfully reversed the pair's downward motion on the 16th of November. Now, the CAD seems to have been strengthening against the USD in the past few days and is about to end a 6 weeks losing streak. Now, the improvement in the market sentiment, in addition to the rise of oil prices, seem to provide the necessary push higher for the loonie. Fundamentals for the oil market seem to include a more optimistic view regarding the Omicron, as specialists are now downgrading the severity of the variant, with some analysts suggesting the situation remains unchanged. The market sentiment seems to imply that the demand levels for oil are to improve, or at least not to be as bad as initially feared when the Omicron variant made its presence felt. Now, should oil prices continue to rise, we may see the CAD gaining further. On the monetary front, we note the release of BOC's interest rate decision on Wednesday. The bank remained on hold as was widely expected at 0.25%, yet its stance tended to disappoint traders which may have been expecting a more hawkish shift given the stellar employment data for November and accelerating inflation. The bank seems to have stopped regarding inflation as temporary in its accompanying statement and also recognized that employment returned to pre-pandemic levels. On the other hand, though, the bank underscored the devastating floods in British Columbia and the rise of the Omicron variant, which could have an adverse effect on the Canadian economy's rebound. As for financial releases, on Wednesday the 15th, we note the release of Canada's November house starts number, and we highlight the release of November's CPI rates for the same month. Now, as a general comment, and overall the week may provide a substantial number of trading opportunities for traders, as it has a number of high-impact financial releases and events that could increase volatility for the markets. Yet on Thursday, we also get interest rate decisions from other countries, which could move their respective currencies. We make a start with Turkey's CBT, which has cut rates in its last meeting, and there were reports that the bank's governor hinted towards another cut in December's meeting. Now, should the bank actually proceed with another rate cut, we may see the TRY weakening further. Also, we note the release of Switzerland's SNB interest rate decision, albeit we suspect that the bank is to continue to maintain an accommodative stance despite the CPI rates for November accelerating on a year-on-year level, given also that the Swiss government has lowered its growth expectations for the economy. Last but not least, we get from Norway Norges Bank's interest rate decision. The bank in its forward guidance had clearly mentioned that it plans to hike rates in the December meeting, and we expect the bank to stick to the script. Yet there is a certain degree of uncertainty in the measures as the Omicron variant and intentions for stricter measures by the Norwegian government may force the bank to have second thoughts. Even should the bank perform a rate hike, it may alter the downward guidance for rate hikes to come by reducing them, which could also weaken the NOK. That should sum it up for the day. From all of us here at IronFX, best wishes for solid trading. Thank you.